you will see gold and silver expressed to its true fundamental value. And at this point, it's somewhere in the vicinity of $40,000 on gold and about $2,000 on silver. So even at 45 or 55 or 10,000, whatever, it's still undervalued. This is your light. And, honestly, if we do indeed end up in an overt war, meaning if the U.S. ends up, because President Trump is also talking about Colombia next, right? So if the U.S. ends up in an overt war, because of course they're in a covert war all this time, then it would not really surprise me to see spot at easily 7,000 on gold and probably 400 or 500 on spot silver, and they would still be undervalued.
Gold and silver remain structurally undervalued despite recent price gains. Even moves to $4,500, $5,500, or $10,000 in gold would not represent full valuation when measured against debt expansion, currency dilution, and systemic risk. Lynette Zang outlines a framework in which gold's fundamental value approaches $40,000, with silver near $2,000 when priced against decades of monetary inflation. Under this lens, current levels are still early stage. In scenarios where geopolitical stress escalates into overt conflict, rapid repricing becomes plausible, with gold moving towards $7,000 and silver into the $400 to $500 range while remaining undervalued in real terms. The focus is not on short-term volatility, but on preserving purchasing power as financial risk accelerates. Now, we present the clips from Lynette Zang's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Nothing goes straight up, nothing goes straight down. I would expect some bouncing along the way, and the spot gold and silver markets are technically extremely overbought. And when you look at them, which is something that I have been taken to showing every week on my live, just so people understand where we are in the markets and then what's most likely to happen next, we could see some profit taking and some pullbacks in there in the paper contracts. That doesn't necessarily mean that in the physical world that there wouldn't be extended premiums, because there's a finite amount of this in the physical world. But I would think that by the end of next year, what we're going to see is silver spot substantially higher than it is even now and it did break 70 a little bit earlier today. And spot gold, I can see easily somewhere around 5,500. But what I also want people to absolutely understand, because we're talking about that currency reset, that is when
analogy, and I want to come back to that real quick, because you only use headlights when it's dark. Of course, the question is it winter, is it summer, and what time of day is it right now, Lynette? Like what is it? The night is always darkest before the dawn. We all know that. So the question is, what time is it, and what do you think will happen in 2026? Let's try forecasting just a little bit. Like, what are some of your expectations? How quickly will all of this happen and unwind here?
Wow, let me see. I really do need to get a crystal ball.
It might be helpful.
Having said that, using my technician's view, okay, nothing goes straight up, nothing goes straight down. I would expect some bouncing along the way, and the spot gold and silver markets are technically extremely overbought. And when you look at them, which is something that I have been taken to showing every week on my live, just so people understand where we are in the markets and then what's most likely to happen next, we could see some profit taking and some pullbacks in there in the paper contracts. That doesn't necessarily mean that in the physical world that there wouldn't be extended premiums, because there's a finite amount of this in the physical world. People think that they can just go ahead and revalue just like that. And it doesn't really work like that, because as soon as they do that, is that really going to pay off the debts that they continue to grow? So if you think about it like an individual getting credit cards in the mail when you know you're going to declare bankruptcy, more debt, more credit, because you know you're not going to pay it. And so, yes, there's not one little doubt. I'll even go as far as giving you 100%. But 100%, we do see a revaluation in the future, but not until we have hyperinflated away the rest of the value that yet remains, the rest of the trust and the confidence that yet remains inside of the system. So I pay a tremendous amount of attention to that consumer confidence and sentiment, and the inflation expectations and all of those indicators, because I personally believe that the hyperinflation has already begun. It is just not yet visible. So what we're seeing today, and especially the fact that you've got, what's the central banker's real job? It's not to protect you or me. My goodness, no. That is they are all private corporations. That is to keep your confidence in the system so that you keep your wealth in that intangible fiat money products, and it's easier to transfer your way. And so when you're looking at really what's happening with the central banks, and Italy's brought up a really, really interesting point that I want to talk about in just a second. But when you're looking at the central bank guidance, none of them are really independent. They want you to think that they are. And so, Fed Chair Powell is fighting it. And with the new GDP report that just came out, it's going to be harder to justify dropping those interest rates to create more inflation. However, we're also looking at a major slowdown in employment, and that also would justify dropping those interest rates. But then what does that do? It speeds up what the inflation rate, and the public is already distrustful. The confidence level just keeps kissing that all-time historic low. And I'm waiting for when that breaks through. That will be that hyperinflationary debt clock. It's the timer's already ticking. But when we go to the lowest level and we break that support confidence level, then for me, it is absolutely game over. It is game over. And they will then hyperinflate away the debt. So they repay that debt with, in the US, dollars that have no value, or euros that have no value, or yuan or yen or whatever. And I do think this is going to be a globally coordinated effort. Once that takes place, that's when they will use that gold revaluation account that every single central bank had. They can use it in little bits now, but the big one is to reset us into a completely new system. So they have to have that very, very visible hyperinflation in order to do it. They need that very, very visible crisis in order to justify it. And, let's face it.
Gold and silver are not moving in straight lines, and near-term volatility should be expected. Both spot markets are technically overbought, making short-term pullbacks in paper contracts likely as profit-taking appears. That does not negate tight physical supply, where premiums can remain elevated due to limited availability. Even with temporary corrections, silver has already broken above $70 and remains positioned substantially higher by the end of next year, while gold can reasonably work toward $5,500. Beneath price action, confidence in fiat systems continues to erode as inflation expectations rise and consumer sentiment weakens. Hyperinflation does not arrive suddenly. It unfolds quietly until trust finally breaks. Central banks prioritize preserving confidence, not purchasing power, and once that confidence fails, debt is inflated away. That visible crisis sets the stage for systemic reset mechanisms tied to gold revaluation. Let's get back to the interview.
Really, let's kind of talk about the squeeze a little bit, because we're looking at two different markets, but we're talking about them as if they're the same market. So there is the trading market, and that's really where that squeeze that you're talking about comes in, because it's just been like Wall Street always has to have something to hype, right? So they're funneling into the silver contracts, the gold contracts. However, in the real world, both silver and gold are used in every single sector of the global economy. And so in the manufacturing sector, when you're looking at the slowdown in the global economy, that's where you would not see a squeeze, but there needs to be. And to me, a squeeze doesn't necessarily mean that there is a top on it and then it's going to implode. In terms of contracts, that could be applicable. But in terms of sound money, physical gold and physical silver, when demand in one area, let's say it's the manufacturing because of a global slowdown, happens in this area, well, look at what the central banks are doing for themselves. And if you think we're actually even getting any good data there is this bridge in Brooklyn I could sell you. I don't own it, mind you, because the central banks have been accumulating gold at basically the fastest level in history over the last number of years. But that accumulation really started in 2005. It did not just start. And that coincides with what happened with the great financial crisis in 2008. That's when it became visible. It was happening before that. And I think that that's really what those gold and silver, the spot prices are telling us, is that something extraordinarily nasty this way comes. That's why I said that's the headlight, right? That's what's giving you clarity and safety. And yeah, there is going to be a squeeze, but that's because there is, unlike those gold and silver contracts, there's a limited amount of this stuff. Silver does get used up in production. Gold is recoverable. Gold is the primary currency metal. Silver is the secondary currency metal. And I will tell you this, because very often in my work, I go to a currency converter chart and I'll look at whatever, go to whatever one you want, pick any currency at all that you want, and then you do it against the US dollar, you do it against spot silver, and then spot gold. Now, typically when I've done this in the past, what we have seen, I would say about 99.3% of the time is that spot gold always outperforms spot silver, and spot gold always 100% of the time outperforms the US dollar. And that is certainly happening in terms of the US dollar. But what we're actually, and I know your viewers are going to want to know this because this is a big question that comes up all the time, is that gold and silver ratio, which was like this. I mean, it was off the charts. That's why you can't even see my hand. And history shows us that as we move toward hyperinflation, what we see is that narrowing of the gold and silver ratio. But then again, once we are firmly entrenched, I should say, and the hyperinflation becomes more visible, then it's not that you're going to see that widen. You're just going to see, probably, if history repeats itself, you're going to see gold outperform silver because it's the primary currency metal. And that is against which they revalue those currencies, which is another interesting point because you never hear the talking heads in the past talk about that revaluation trade. And now that's such a good thing But it may be for traders, but it's not for the normal person out there that is struggling to feed their families and to pay their mortgage and their debts and build a life.
Gold and silver are often discussed as one market, but in reality, they operate across two very different arenas. The paper trading market amplifies momentum and speculation, while the physical market reflects real-world scarcity and utility. In the global economy, both metals are embedded across manufacturing, energy, technology, and finance. Even during economic slowdowns, central banks continue accumulating gold at historically aggressive rates, a trend that began well before the 2008 financial crisis. That steady accumulation signals rising systemic risk, not hype. Silver differs in that much of it is consumed in production, tightening long-term supply. As confidence in fiat currencies weakens, gold remains the primary currency metal, while silver plays a critical secondary role. History shows both consistently outperform paper currencies, especially as monetary stress intensifies. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.